Good evening. This is Ken Long from Tortoise Capital with a review of the weekend trading report for July 25th, 2015. Market is in sideways normal condition, so we're going to shorten up our time frames, be more likely to take the profits when we have them rather than holding out for follow through the next day. We're going to expect larger intraday range moves as there's more tactical trading going on. On an annual basis, using weekly RSI 14 right in the middle of neutral at 51 out of 100. Using the 10-day NDX, we are oversold at 7 out of 100. In the market mosaic, price with respect to the 200-day moving average is at 1.55%. That puts us into red sideways. The slope of the 50-day moving average is exactly flat. ADX is an untrending 16.3. The risk index is the 30-period moving average of the VIX divided by the 10. 1.0 is the threshold between risk on and risk off. Current reading is 1.16, so we are in risk on conditions. Take that score, compare it to the last 5,000 trading days, find the average and the standard deviation. That gives us the risk Z score, which is at 1.86. So we've moved from worse than minus 1.5 to a positive 1.86 in the last 10 days. So quite a shift in the volatility regime. This is at such an extreme level that rolling over of volatility here would not be unusual. We can expect more volatility once we see this rollover. You can see the holdings of blended monthly rebalancing, and then the winners as of Friday's close of business. ETF2, the theoretical exposure is back to 10% with this week's sell-off, and the model portfolio itself will be at 80%. You can see everything in the ETF 13 BMR portfolios in cash with the exception of technology. ETF 32, not much different. You have some strength here in discretionary financials, tech, healthcare, staples, and the short bond. In the ETF Max, agriculture, biotech. Global carbon is of interest. It had a big week this past week, but not much else really did. You see, there are a few of these leaders that took a hit. You might be interested in looking for rebounds there in biotech. More biotech, cocoa, and more biotech. So to me, that's one that's definitely worth stalking. That's been so good for so long that there will be some people looking at this as a buying opportunity to get in on the strongest sector after it's been on sale. Excuse me. So we'll be ready to play that in both directions. The S&P 500 through the same lens. Amazon had a great week last week. Under Armour also. Starbucks quietly sneaking in with all greens. There's the pullback in Google and the A&B shares. Should also be interested here in Equinix and Zion Bancorp. Netflix suffered less than most of the others this past week, so still that's going to be a stock of interest. Looking at the market health check, the vertical blue lines are 10, 20, and 30 days worth of look back. Here's the 60-day. Purple line was the previous swing high, which was exactly rejected on Monday and triggered sharp sell-off. The dragon on the far side of the river is now rolling over and coming back. You can see that we're about 2.5% pullback here these last 5 days off of that swing high. It's right in the middle of this noise channel. You can see the 200 period moving average steadily creeping up and causing some pinch here as far as market direction. You know, we're running out of wiggle room in this market. The oscillations are getting bigger, as you can tell by length of the legs that the dragon has traversed. The 30-period regression line slope has rolled over. It just went positive earlier, or at the end of last week, but has now started to roll over given this pullback. We can see the slope is still positive on the 30, negative on the 10. The jaws of PPO have closed to the upside, so we're really in the bottom half of the river in sideways conditions. This is pure tactical chop right now. You just notice the size of those signal bars in either direction, and that's why it's panned to be a short-term intraday trader here these past 30 days. Only one of the market sectors is on a buy signal for ETF2. That's technology. Everything else cash. And even in the sector spiders, only 4 are on positive signals, with strength in consumer discretionary, healthcare, and financials. World market model, everything in the U.S. above average, Japan above average, China above average, but then a mixed bag in the rest of Asia. Europe generally above average, and in some exceptionally so. Weakness has returned to Latin America, emerging markets, and Brazil. Private equity doing well. The commodities fared a little bit better this week, with the exception of oil, coming out of the red into the yellow, but still problematic in the commodities. This is the ETF2 lens, looking at the top 30 in the ETF2 database. Biotech and financial still at the top. Italy still doing well. Emerging leaders here are those in the green under strength, and white in consistency. That's the a recent move to the top is what that's showing. So consumer discretionary, financials. See a lot of financials in here. Home construction, home builders, healthcare. Among the Dow, Goldman, and Morgan at the top, as you'd expect with the financials. Home Depot moving back up to the top. It used to be red, and now it's up into the green. So at green and white, that still has some room to go. That's on my short list for trading now. Procter & Gamble in the white and yellow is making some move, as is Travelers, white and yellow. And these that are red and yellow are ones that have newly found the bottom. So right now, DuPont in the lowest position. Walmart has moved up a little bit off the bottom. It used to be the worst. So let's think about Walmart as a slowly improving opportunity. Into the daily report, quite a few auto framer signals given the pullback. That's not surprising. Lots of channeling and overreaction signals to work with here. You can see that the volatility regime came down to the midpoint and is now much quieter than it was, although it's fairly near the 100-day average of volatility. You see the bears are in charge in terms of the ADX trend. Lots of 5DDs and channeling and overreactions to choose from here in the Dow 30. A lot of RSI2 values. That's not surprising. Cisco and Visa had the best days. Visa should therefore be very interesting to us. I mean, it was up 4.3% on Friday, dominating across the board, and it's in financials. I would definitely take a look at Verizon tomorrow. Leading the way here with the max pain range compression in the auto framer, you see a lot of things better than 2-to-1. United Tech and Caterpillar almost 6-to-1. IBM at 4.5-to-1. Lots to choose from here, so we can afford to be selective. A lot of 5DDs in the ETF 30. Brazil at 4.8 on the auto framer is number 1 on max pain range compression. 3.6 fraud quality and RSI2 value of 1, and is exceptionally beaten down over all of these time frames where it's highlighted red. Therefore, it's of interest to me. Yeah, so a lot to choose from. In the auto framer, this is the mechanical trade framing data. Everything that's at least 2.5 to 1 on a retest of the swing high, just using mechanical risk. And then in the regression line fractal framework, the top shelf ones here are the ones that are the most below their own RL270. Those are the value plays: DuPont, United Tech, Walmart. Walmart is of a lot of interest to me here. It's 8 ATR below its long-term fair value. How do you not like that? And then the ones in the red are the ones that are the most numbers of their own ATR above their respective RL270s. So think of these as the relative strength leaders. This is the pinch summary, the pinch setups. These are ones that, using this risk, this is all range risk, when we take the range stat, which is the maximum reasonable intraday move, and divide it by the risk, the mechanical risk, this is still what the single day reward to risk ratio is. These are all looking favorable. There's a couple good ones in there. The usual. We're right at the long-term, the 10-year average of the RL30 slope. So this is an absolutely normal condition. See how volatility has pulled back and starting to rise a little bit. And the rest of the charts I'll just flip through without comment. This is for your review. This is of interest to me now. The RL90 has come all the way back to the long-term average, the 180-day average. The 10 is now below the fair value line, and 30 is right at fair value. So this is actually baked in some nice potential. And the last time that it did this, the 30 was well below, and the 10 was well below. I was back in here and set up this nice bounce. So, and then this is about a similar location here. And in both cases, you got nice bounces from price at this level. So this would actually be a sign of healing if it were able to hold above the edge at the southern edge of the river and to resume. And that's everything that I want to cover for today. This is Ken Long from Tortoise Capital. Keep your risk measured and powder dry. Tonight we'll go over some the swing charts for members. There's quite a few attractive looking trade frames, so we'll get on that tonight during the webinar. Thanks for your attention.